Hi everyone, welcome to a massive Monday market update. I just filmed the Mastermind Monday market update, and boy, was it an eye-opener. Just so much risk in the air, and macro is looking even more bearish than maybe we looked at the last few months. So that's pretty crazy. And just a few minutes ago, we saw the British pound get obliterated against the US dollar. So all being driven by US dollar strength right now and the sell-off in bonds globally. No one wants to own bonds. All they want to own is US dollars to pay off their debts and for the idea of safety. So that is all a really interesting dynamic, but it's got the global economy on the ropes. And I don't want to sound too doom and gloom, but that's what I'm saying. That's what I'm hearing in the charts as well. Not that you can hear in the charts, but maybe it's what I'm hearing elsewhere on Twitter and whatnot. There's some very smart people that are pointing in the direction that it needs to be a circuit breaker moment, or at least that's my theory. I feel like we're heading towards a circuit breaker moment. Now, while that is being said, this is still a tremendous time to look at these markets, because once there is that moment, risk markets like equities, like crypto, historically, we've seen, like in COVID, they are the fastest to recover. So if we're looking at it from that point of view as a long-term investor, if you're looking at on-chain data, sentiment, technicals, all that, you would look at Bitcoin here under 20,000 and go, gee, that's a reasonable risk reward. Sure, it might go down another 10, 20%, maybe even a little bit lower. But if that's all part of your strategy to really look at the opportunity that is layered down below in front of you, and have that longer term time horizon. And when you look especially at the macro, and I know we're looking at the macro in a negative light, but if you look at something like Bitcoin that was actually built for a moment like this, and yes, right now it's tightly correlated to risk markets and currencies, but eventually that correlation will break based on its use case and what it's there for. 21 million only. The world's really suffering under the US dollar just skyrocketing and eventually being printed into oblivion. All other currencies are facing that right now. The US dollar is the cleanest dirty shirt in the laundry, global reserve currency. Right now it's backing the entire system. That is not quite healthy at the moment. It is just artificially being pumped to oblivion. Meanwhile, that is crushing all the other currencies and emerging markets underneath. And it stems back to the Federal Reserve, what they're doing with the tightening. But at the end of the day, this was kind of built over many, many years of low interest rates, endless debt, irresponsible monetary policy. And we're getting to that point now where there needs to be an alternative there, maybe like a life raft, if you will, something on the sidelines that you can look at and go, all right, well, I need to hedge myself here, whether it be gold, whether it be Bitcoin, whether it be crypto, have that longer term time horizon, because right now it's pointing towards that. We're heading towards, again, that circuit breaker moment. And if you're investing in this market, you would have sort of looked at it and gone, all right, well, this is a good idea, but eventually we're thinking that the current financial system will have to diminish or lessen with its relevance, and something better needs to emerge. And we look at crypto and we think that, and we place a calculated bet, an idea in our investment thesis that this over here might eventually overtake what we've got already, because it's inefficient, it's highly manipulated, and in the end, they can just keep printing money and it's going to zero. So we have to always have that in mind, that while the macro looks bearish right now, currently, longer term, it's never looked more bullish, because likely there needs to be, or will have to be, that pivot if national currencies go under, whether they dollarize or not. And I'm probably going into the weeds here, but I just wanted to sort of spell it out. If you think things through logically, if you're looking at charts and feeling a little bit fearful and uncertain about what's going on, really outlook, have that longer term time horizon, and just see where the world is going. Is it wanting to go more authoritarian? You want to go harder into these national currencies, it just keeps getting printed, and go to CBDCs, whatnot, or are you looking at the more decentralized world, where we do want still control over our own money? We don't want central parties behind it. We don't want banks that are constantly going insolvent, and likely we're looking at more banks going insolvent pretty soon. To look at Credit Suisse, we saw in 2008 that if the government doesn't come in to backstop those banks, you lose all your money. So you have the broader picture in mind. This is always going to happen, and whether it happens right now or more at an accelerated rate, which is what I'm feeling might happen. We might see something big happen here, a bit of a crisis, but then the can will get kicked down the road with more money printing, and then we likely see a much bigger moment down the road. But it's all about how we look at it and how we structure and position ourselves. So I wanted to get that across, because again, we can be a little bit doom and gloom sometimes, but we want to have again, that bigger picture of course, there as well. Okay, now get off Twitter because I'm just following what's happening with the British pound. But here we go. I just wanted to bring up the pound and just show you the sheer magnitude of this, because right now this is a national currency like the yen as well that is trading quote unquote like a shitcoin, like a cryptocurrency, in a full-blown sell-off. And when that happens, you have to just step back and go, okay, well, something is happening here, something is breaking somewhere, and is someone going to step in? Because otherwise these markets are going to get quite disorderly quite fast. And the reason the British pound is selling off is because internal monetary policy. I won't get into that right now, but currencies around the world, regardless, are being sold off to buy US dollars, because right now it's just climbing, climbing, climbing. If we have a look at this inverted relationship between, inverse relationship from the dollar, so we see the pound getting smashed, and the DXY, which is the US dollar, based against a basket of other fiat currencies. So the pound might be in there, the euro is probably in there, the yen's probably in there. All those currencies are getting absolutely smoked. So what's happening with DXY? Of course, it's going higher. And the Federal Reserve is tightening monetary policy and being more aggressive. So that constrains the supply. There's not the liquidity being pumped out in the market. So we're kind of moving to that point where liquidity markets either break, lock up, credit markets as well, where new liquidity injection is required just for the system to continue running. And that's where we're heading in the next couple of months. I don't know if it's going to be just around the corner, but we're seeing a repricing of a few things. Now, just looking at this quickly, Bitcoin looks to have jumped by about $800 just in the last few minutes. That's interesting. Okay, so lots of things happening, but Bitcoin, let's just keep things super, super simple. So what we're looking at here, this is my 145-day box. So this is the same box that was that I've drawn on the 2019 bear market, when things looked a little bit bleak. We had the rally up to this top trend line, then we had the pull back to the 0.786 line of Fibonacci retracement before we eventually climbed out and got out of this accumulation range and into a new phase of the market. Now we're still tracking in that box, regardless of everything that's happening. I am deeply surprised at how well Bitcoin's being held up, but touch wood, whenever you start thinking something like that, the floor sometimes can be pulled out beneath you. But just looking at the chart, what Bitcoin needs to do, absolutely, it's obvious, hold this previous low, 17,500. You can see it's trying to trend down towards that way, but it's just not sure yet. Also, the RSI on the weekly is trying to move higher, which is interesting, and it's broken a longer term downtrend, but we likely won't see real fireworks from that till another year or so down the road. But let's just again focus on here. It needs to hold this level. It's confluent with the 300 weekly moving average. So this level is going to be a bitch to break. And if it does, then there's a big gap in volume on the right hand side. I'll just zoom out just a tad. It should reappear. It's probably because I've got my writing there. No, it doesn't want to appear there, but there's a gap of volume in this area here. So we should see a pretty big drop and a bit of fear in the market if that 17,000 gets cracked. And it should fall down around about that 14,000, 15,000 to the 400-week moving average. So these are the lines we have structured in our newsletter. So just keep that in mind. If you ever want to go back and reference why we have certain levels in terms of buy zones, make sure to go back and look at the newsletter, because we're structured around longer-term moving averages and different Fibonacci retracements as well. And yeah, so the thing is, this could absolutely drop back down to 10,000 if these levels are breached. These should be really strong areas of support, but you have to have in the back of your mind, how low could this go? And no one can actually tell you where that is. I think in the newsletter we have our danger zone at around 12,000 or 10,000, because I think once 12,000, if that actually gets taken out, we're probably just going into those lower numbers fairly quickly, and then buyers should come in at those levels, because it's almost like a massive overreaction to the downside, and then you see wicks start to come out. And again, that's just my hypothesis, but I think these levels are going to be huge to break, and as of yet we still haven't broken the previous low. So people can get hysterical and call for new lows, and I see all over Twitter that we're due for another leg down and stuff. And while that is absolutely possible in the macro, if everyone's expecting something, generally the market doesn't do that. And especially you need to think, have we taken out the previous low yet? No, we haven't. We have not. And if you're looking over a longer term time frame, you just have a look here. We've got on the RSI, on the daily especially, I'll just let you in on there. We have a bullish divergence there. So price has actually made a lower low while actually gaining strength in the RSI on the daily. So that's important. Strong daily bullish divergences are really important to pay attention to. But if we have a look at the low over here, 17,500, this next I can say low over here is higher than the last. If we really get out of this and get higher than this previous candle in this next little zone here, then that's a pretty significant higher low. So that's really important to visualize and see in this bear market trough. And I just wanted to bring that up. Now, contrarian argument to that, this is very similar, or in fact, this is a fractal, in fact, of this area here before we had to break down into lower areas. This is what it could look like. We have a bit of a grind, a climb up, and then a drop down into these areas. That's absolutely possible. It's just a fractal. Doesn't mean it's going to repeat. Doesn't mean it's going to rhyme. So, and I just overlaid for the masterminds as well. You can just read there just some of the macro risks that are just hovering over. I've never seen so many, or never read about so many hovering over a market in modern history, I should say, you know, going back to certain wars and whatnot, but some serious issues just hovering over everything. And yeah, we're going to see how markets react to that, because it seems like right now, while we're in a massive debt crisis with yields, so bond yields climbing and screaming higher all across the world, the currency crisis aspect seems to be hitting right now, especially when you see national currencies like the British pound, the yen, you know, and other massive currencies start to trade with high volatility. It's something you have to really pay attention to. All right, moving on to the S&P 500. Just want to touch on this because this is the futures of the S&P 500. This is the US stock market, top 500 stocks, tech stocks at least. So just looking at this, if we have a look at the longer term on the weekly, this is a bearish pattern. Looks very, very bearish. My son's just trying to bash down the door to get in the room. Very, very cute. But if you have a look, it's a descending triangle. We're down at the base now. This is a very bearish looking formation. And if you're looking at what's happening in the macro and whatnot, it looks like we are due for that leg lower in stock. So pay attention to that. We've got the 200-week moving average just below this line here as well. And what I've just drawn here, and I used it with the masterminds, is once this cracks, there's this big gap in volume. And if it lands in this box, which seems pretty prominent in terms of the volume down here, it looks like a good spot. What's actually quite poetic about it is this is the area that the COVID stimulus, those trillions of dollars were thrown at the market when we had the inflation of the bubble towards the top again, and now we've had the real cooling off. So falling back into that would make a ton of sense, and it wipes out all that, I guess, excess liquidity that was in the system prior to that. And I think the Fed would like that too. All right, if we just pivot on over to leave you with a good bit of news, because again, you can look at the macro, then you look at the technicals. You need to partner it up with data. You want to partner up with hard data. And I'm just going to bring you from Will Clemente some hard data in terms of on-chain analysis. We also put it in our newsletter as well. I just want to pick out the best on-chain data sets that I think are super relevant right now. That gets released this Thursday. Make sure you tune into that. But if we're looking here, I love cost basis. So realized prices, average buying price, because markets tend to adhere to that. Short-term realized price is really interesting as well. When we're generally above that, we're in a bull market. Short-term buyers are confident. They spend more money. They get more bullish. They speculate more. It shows you the market's more in a heated state. Long-term holder of realized price, I mean, you don't want to fall beneath that. It's generally in a bear market. So the short-term realized price is the pink. Longer-term realized price, average buy price, is the blue. And every previous bear market we see a cross. Now, Will's pointing out that we have seen finally a cross of those very two important metrics. And again, generally in bear markets, we see the cross, I guess, once the sort of the horror of the bear market's over, if you will. We have it as almost a lagging indicator, and then we see the cross again on the other side once it's fully out and we're into that new phase. So again, what we're talking about, say that 145-day box, it may not be 145 days, but you might expand it out to 200 and just think, well, in this zone, this is where we generally see bear markets bottom. If it doesn't bottom with that, it goes lower. We haven't found, obviously, the true low, and we need to go into another accumulation area. So that's what I wanted to get across. Also, we're just about to go into this, I guess, green band here, cost basis ratio. Generally, it just shows you that we've got some sideways accumulation grinding further to go. So that's interesting. I suspect, though, this time is different. Something has changed. Obviously, with the macro, we could see either an acceleration out of this area to the upside if certain factors or macro goes our way. Again, that's a little bit of hopium, but I just want to put it out there. Also, on the flip side, we see an acceleration like a COVID, where a big catalyst hits the market. We could see a rip down, an acceleration to the downside, and then we can see us trying to climb out rather quickly. I think things are accelerating either way. Risk will react quite heavily to whatever happens in both directions. I think negative, we go down pretty quickly, and then we aggressively come out, because there will be a circuit breaker moment where, let's say, the Fed has to stop what they're doing. There's some language that changes across markets, whatever. Alternatively, maybe there's another angle there which I'm not assessing, which is, you know, more longer term bear market potential depression across the world. I don't want to really focus on that. It's probably something I'm more talking with the masterminds about and looking at some key data sets. There's no question things are looking quite bearish, but at the end of the day, this is a highly manipulated market, and it can change just based on sentiment. And if things change with the dollar, if that starts to drop off, if yields start to drop off and the Fed changes their view, then risk markets are going to absolutely fly. So that's just my thesis. That's how I'm looking at it. Again, probably going a little bit deep for this episode as well, but it's just so many things are happening, and I need to keep everyone across it to try and help you see around corners. But I would look at the confluent picture. If you're a longer term investor, focus on the data, look at the longer term time horizon and what we've seen previously. If you're a shorter term investor, you look at these markets and go, okay, I need to be more in US dollars right now. I need to be more risk averse. I can inch in very, very slowly as my levels are hit, of course, the dollar cost average. But apart from that, you have to be quite careful about how you approach risk markets right now at a time that we just expect there's going to be volatility either way. And that's where we're such a big proponent of the dollar cost averaging strategy as well. So I'll leave that with you. If you're hearing me speaking, you have no idea what I'm talking about, then please get in touch with our team, because you need to do our masterclass course to give you the foundational pillars for how to invest in this market. So apart from that, any questions you have, let me know, let the team know, and we're more than happy to answer. So have a wonderful day and watch these markets. Exciting times. See you guys. Bye.